Welcome to our house. This is a house that is actually built on risk. It's built on risk transfer. It's built on risk assessment, risk analysis, and it won't surprise you then that I'm going to talk to you about risk, because we've been hearing over the last several hours about all of the extraordinary opportunities, but also daunting challenges, the trade-offs I think Yvonne Martin talked about this morning, that'll have to be made in order for this, the extraordinary future demand that we actually want to have for energy to be fulfilled. We want to have it because accompanying that demand will be quality of life improvements radically around the world. So that companies are going to need to make trade-offs, and those trade-offs will involve risks. So I'm going to take you into my world for a few minutes, and that is a world of helping individual companies to decide what to do about risk and risk management. And the examples I'm going to use, and it's really most of my background is in the oil and gas sector, so I'm going to use the international oil and gas sector. You may be interested to know that with regard to the comments on China a minute ago, that much of what I'm going to talk to you about, I talked with some large Chinese oil companies about a few weeks ago in Beijing. And I would only comment that their keenness and ability to appreciate and absorb points about risk and risk management are no doubt reflected in every aspect that they're looking at in this industry. And I would expect that in the fracking business in China and all developments, where they want to go, they will go. And they'll go quickly, and probably twice, 3 times as fast as we expected. So this is all going to be quite a thrilling next decade. And I'm happy to talk with you about it. So let's see if I've got this right. No? Keep going? Yeah. Well, that's me. Best practice in risk strategy and governance in the oil and gas sector. And I'm going to accelerate through a few of these charts because this is something I was going to spend some time with you about how we look at risk. And suffice it to say that the end product, read it from right to left, the end product is the implementation of a risk strategy. A risk strategy is something that most corporations outside the financial services sector do not have. Risk is usually evaluated and located in silos, in the financial side, the operational side, the insurance side, within large corporations, which is not the way to do it. The way to do it is to think across these silos, think about risk in a single language, and that's the summary of this chart. Basically, there are two, you can manage risk, by avoiding it or mitigating it. You can finance it by retaining it or transferring it. And then all of the way to make those various trade-offs is through those steps from the left to the right. Okay, everyone got it? Fine, let's move ahead. And I want to talk to you about extreme risks. And by extreme risks, I mean those risks that can kill a company. So really black swans, whatever you want to call it. But the risks that are going to make companies not be brave, make them lack courage to make the sort of decisions that we're talking about in the energy sector today. So what we've done is we've taken the S&P 500 and the FTSE 100 companies. We've looked at them over the last 20 years and at share price performance. And our kind of main summary from this is that these companies, these very prestigious companies, and these are the most prestigious, the best managed companies in the world, suffer an extreme reversal of fortune once every 7 years on average. Okay, where there is a severe underperformance of their share prices, short, sharp shocks that they don't recover from on average for 2 years, every 7 years. That's fact one. Fact two is that among all these companies, 95% have suffered at least one of these events in the last 20 years. This is not rare. These reversals are part of the nature of things. It's not something you can avoid no matter how well you manage your companies. Because the problems that cause, and the multiple issues usually that cause these extreme events they'll hit you at some point. And this is certainly true in the oil and gas sector. It is no surprise that perhaps the most notable example of a reversal of fortune in the last several years was BP's Macondo well. This was a tragic event with many people killed. And it was tragic also from an economic standpoint, with entire coastal economy shut down, and with BP's survival threatened. It's quite extraordinary to think that a company the size and the liquidity, the profound liquidity of a BP could have been nearly brought to its knees by what was, at least apparently, a single event. Of course, it wasn't really a single event. There was technical issues. There were a lot of operational issues. But the event happened in the United States. And in the United States, there was a very rapid political response to that event. And because so much of the future of the oil sector is in the United States, the Gulf of Mexico, BP was in a position to have to give up a lot of economic value. If that had happened in Angola or someplace else, very unlikely. We might have heard about it, but it would not have resulted in the kind of economic hit that BP took. So one of the fundamental points about a black swan or an extreme risk is that it's usually the result of multiple events. Things that the insurance sector, dare I say, is usually not very good at responding to. We insure all kinds of things in the oil and gas sector, gigantic facilities and business interruption. We have an extraordinary penetration in this industry. However, for the extreme risks, as the scale of projects in this sector gets incredibly grand, where a single location may be the focus of 10, 20, $30 billion of investment. We don't have much of a reply to that as yet, to that set of challenges. So on the theme of innovation, there's a tremendous amount of innovation that has to go on in our sector, the insurance sector, in order to support the development of the oil and gas sector going forward, or we will become irrelevant. So the burning platform is there for us. For this kind of an event, it's probably the most important kind of an event that we could possibly hope to be able to provide some comfort to for the companies that we serve. And that's what we'll talk about for a few minutes today before getting on to the top 5 or 6 threats to the oil and gas sector. So these are just some examples of the 1,853 of these events that we've tracked in the last 20 years among the 600 companies. This is obviously not the oil and gas sector, except for one of them, and there's an electric company on the latter one. But there are all kinds of reasons, again, why companies go through these extreme reversals of fortune. These dots represent the underperformance of shares among these companies. It's not quite 1,853 dots there, I think, but you can see that they happened all through the period. There were a few bundles around the 2008 crisis, and you can see some concentration around the millennium, but these events happen over time. Now, one of the things that's so important to know about this kind of sharp reversal of this underperformance of share price is that along with it, some kind of credit event usually happens, some sort of liquidity problem in particular. And this is a picture of what happens. This is BP's Macondo circumstance. Back in 2010, in April, the event happened. There was on the bottom of this chart a rapid fall off in share price, and on the top, that's the credit default swap rate. And you can see that that skyrocketed during the period, which is simply a proxy and a sort of an indicator for the broad financial issues that BP was suffering. It was a real shock. And We can show you many dozens of these examples from every sector, and including the oil and gas sector. But this is perhaps a good one here. Now, BP's share price has not recovered in the little over 2 years since this time. So these kinds of shocks are really fundamental. They have changed their strategy. They've changed their management. They've sold off $35 billion, according to Mr. Dudley, about $35 billion of assets in the last couple of years, some of which they probably would want to have sold off anyway, but they were clearly motivated to rapidly change their strategy as a result of this reversal of fortune. Now, when BP and the other major oil groups are out there making decisions about where they're going to invest, whether they're going to frack, whether they're going to go offshore, deep water, shallow water, what kinds of technologies, sort of thing, they will take into account the recalibration of their worst case that the Macondo experience has unfortunately provided them. It doesn't mean that they're not going to make the investment, but there is we certainly sense and we see a much more sort of disciplined and integrated view of risk in these major oil groups. They've always been good at assessing, in particular, extraordinary at assessing technical risks and operational risks, but looking at it from a holistic standpoint is something that is for most of them, relatively new. So that's the BP example. Now, if we look at Tokyo Electric, it's even more shocking. And you can see the plummeting around the tsunami and Fukushima's issues on the left, and you can see the credit default swap on the right, and you see that it didn't get better, it just got much, much worse until they were nationalized. And as you think about some of the offshore gas and gas LNG facilities, the Stockman project, some of these massive concentrated tens of billions of dollars projects, and you look at their proximity or the susceptibility to natural catastrophe risks, you've got to believe that they look at these examples and shudder. So again, this throws back onto us and also on the capital markets sector, the question, well, how can we help? Because this is an indication that banks are walking away. You know, this is an indication for BP, as you saw a similar chart, that really when a company enters a crisis like this, they're going to their traditional financial sources are drying up. So what do we do about this? Because the kinds of bets, if that's the right way to put it, the kinds of bets that need to be made need to have some comfort that they're going to survive events like this, particularly if they happen every 7 years, let's say. So anyway, what we've been doing is hopefully listening carefully to our clients, and we have been working on developing products that arrive with a lot of cash on the left-hand side of of those charts when it happens. There is a bit of a perhaps well-earned reputation in the insurance sector that insurance companies, when there's a major claim, one of the things that quite often happens is insurance companies that's when the debate starts in terms of payments and that sort of thing, claims payments, which is not a good reputation to have. We need something that pays immediately for things like this. And so the product family that we're developing is not with the insurance companies in the first instance, but with the capital markets, working with particular investment. We're working with Goldman Sachs at this point. And we have a product that has a single trigger that's based on a certain share price metric that provides an injection of a material amount of capital immediately when something like this happens. It requires a certain process we're going through, and it's not brought home yet, but it's possible. and indeed incredibly important for us to be able to provide protection for companies of the sort that we're talking about. Protection when it matters. Most large oil groups are not really interested in traditional insurance, which sort of has low deductibles and is a very busy kind of product. These companies have enormous appetites for risk, but what they do need is they need protection from the Macondo kind of experiences, or at least that's a much more potentially attractive opportunity. So in terms of products, we need to innovate, and our banks need to innovate. Other brokers, insurance companies need to innovate to ensure that we help the companies that are making the trade-offs that we're talking about today, getting into all these new technologies, new geographies, all of that, to help them be brave enough to really go ahead and do that. And we think we'll play a role in that. Let's talk about the 6 major risks. We won't have time to talk about all of them here. That we hear around the world, the large oil and gas groups, worried about major oil spill. Nothing too creative there. It's pretty obvious why we're worried about major oil spills. And what do they do about that? One of the things is to really understand what the risk is. And when you hear from quants of various kinds that a risk is a 1 in 1,000-year risk or a 1 in 200-year risk, that sort of thing, we seem to be going through a 1 in 200, 1 in 1,000-year risk every year, every month, it seems, someplace. So you really have to have a context of really how you think about that. We have not been very helpful as an industry in characterizing risk because when you talk about a major oil group, they've got assets around the world. The fact is that they have enormous exposure to all kinds of risks around the world. They're probably going to suffer a 1 in 1,000-year risk pretty often, maybe once every 7 years. So very, very, very often. For the major oil spill, we built an oil spill model. I'll tell you a little bit of a story. We were hired by the House of Representatives, state of Florida, to look at assessing the risk of opening up their offshore sector to drilling, shallow drilling. And between January and the end of March of 2010, we did that. Delivered our final report on April 14th, and we told them the risk was serious but manageable. A couple of days later, Macondo blew out, and the whole game changed. But since then, we've built out a model that takes into account Macondo and other ways of getting to grips with tail risks, and we can, for individual companies, help them assess their oil spill risks. I just touch on the Gulf of Mexico here. What the model says is that under current drilling rates, there is about a 5% probability in the next 5 years that there will be a 1 million barrel spill or greater. But that probability doubles every 1,000 feet that you go deeper. I mean, it could happen tomorrow. But the fact is that it's not a 1 in 1,000, it's not 1 in 200. When you look at the industry risk, which really, as it were, we're all in this together, it's not so important that it's, of course, BP suffered the most from the Macondo spill, but the whole industry was affected by the Macondo spill. And so by modeling things properly, you can get a handle on risk, and you can begin to assess it and make some decisions, be a bit braver perhaps, or perhaps lose courage and go somewhere else. But at least you'll have your eyes wide open. Let's talk about an oil price collapse. This is something that's should be, I think, a fear across the industry. Maybe I'm a bit of an outlier here. I think a lot of people are talking about issues about an Iran attack, Straits of Hormuz, and the incredible fear of a skyrocketing of oil prices. I think it's the other way around, actually. If we look at the behavior of oil prices in the last, I guess this goes back to 1980, and you look at, this is WTI, West Texas Intermediate prices in 2003. I won't get into why it's 2003 dollars, but they're constant dollars. Along the bottom here, and up the right, you get the frequency in the weeks that oil resided at that price. Then that green bell curve on the left is roughly, it's from 1980 to 2002. And the red curve is the behavior of oil prices from 2002 until. And effectively what you see is two different, extraordinarily different regimes of price, where you had a sort of a rough agreement before 2002 between consumers and producers that was expressed in a pretty well-behaved price that averaged out around $18 to $20 per barrel. And on the right, you have a very ill-behaved market, no agreement, effectively, and huge volatility. You could say that's caused by the shocks in the Middle East. You can say it's caused by the enormous increase in financial trading of oil, the incredible takeoff in China demand for energy in 2003. But the fact is that the one thing you can certainly say is that the uncertainty is growing. And there is no rough agreement in oil prices now. But my sort of gut reaction to these observations is that the likelihood, or the risk, as it were, of a plummeting of prices is greater than a sustaining or even an increasing of prices. We could argue about it, but that is at least one take on those issues. So that is something that is riveting the oil sector now, and ought to. And that will be a constant tension as companies make the trade-offs in the investments going forward. A failure of a massive project, just a few observations there. I've mentioned a number of times, and you've heard about the kind of investments that are being made around the world and must be made around the world. Projects seem to be getting bigger and bigger. There's a kind of it's interesting to hear about the fracking as a sort of a more micro kind of investments, but on the other end of the scale, gigantic offshore oil facilities sort of thing. These are incredible single point failure potential projects. Simply we'll say there that during the construction phase at least, let's just back up for a second, for these large projects, these tens of billions of projects, there's not the capacity, the market, the financial capacity in the insurance sector to insure against the destruction of one of these projects. It's not anywhere close to that sort of capacity. In the construction sector, there is enough capacity in the construction phase, there is enough capacity to help out. And what we're modeling and working with companies on is to understand they don't need to buy the full limit of insurance for the entire length of the project, that they can sculpt the shape of and the limits to their, and therefore the cost of their insurance programs, just based on the development of those projects over time. You don't need to go whole hog at the beginning. But the size of those projects is becoming a real problem. Natural catastrophes, we talked about Tokyo Electric. In fact, that there were extremely few of those 1,853 reversals of fortune, extremely few were due to natural catastrophes. But they are out there. And they are increasing, the actual physical events are not increasing in number, but the losses are vastly increasing, whether they're insurable or total losses. The reason that we're hearing more about, of course, the devastation of the Japanese tsunami, about Sandy last week, is that the buildup of assets and living and industrial activity near the coasts has been just skyrocketing in the last 10 years. And so the exposure of people and buildings and productive capacity to devastation is just much higher. And so that's causing a lot of this. What we're telling companies to do is that they need to look at all of their assets. This is, it's just an example. Assets around the world, and we've got all the various nat cat perils: earthquake, windstorm, floods, river floods, coastal floods, etc. And there are very compelling, quick ways to scan the world and model the exposure of their assets to these natural catastrophes. And having identified the red zones, you know where to focus in terms of engineering solutions that will protect those assets better. So Nat Cat, in terms of, I'm certainly not going to read this through at this time of day, but suffice it to say that energy groups, in terms of bringing together at board level and top management level, synthesizing the risks in a single language that they face, have some more progress to do. So this is just an example when we work with companies of impact and likelihood of a particular kind of event, particular sort of risk scenario. The result of those analyses are illustrated here on the left with impact and likelihood. The bubbles represent just certain numbers of risks and that occupy those intersections of likelihood and impact. They're defined quite clearly in a risk register. And then the aim after the mitigating investments is what was arrived at on the right-hand side. So that's kind of an overview of the risks as a whole that a company will want to get a handle on. And then finally, just to sort of come back to our original chart, in terms of best practice, it was quite interesting to see how the Chinese oil groups responded to this. If you take down the left-hand side the elements of that view of risk, and you look at risk identification, assessment prioritization, mitigation and financing, strategy and action plans, and risk implementation, there's a report card that a company can go through. It can be immature, basic, mature, advanced, or world-class. And of course, everyone wants to be world-class. And in those dimensions, every company should be able to, in the cold light of day, give itself a sort of report card on these areas. So one major oil group is here, pretty advanced. That in risk identification, they're not quite at the point where all risks are regularly identified and assessed by and from the board level downwards. In risk assessment, they're not quite at prioritization of aggregated risk across a group with classification by key underlying risk drivers and company killer scenarios. They're not quite to the right-hand point in some of these, but they're getting there. For another independent company, well, large company, but not a major, they're on a program to get from the left to the right. But the key thing is knowing where you are and what the destination is. And our view is that if a company goes through this kind of systematic assessment, they are much more likely to be braver and to make the kind of trade-offs that we've been talking about today. So that's the kind of the work that's underway here. And then finally, in the sort of accelerated version, there's the 10 things that I'd like to leave you with. So get out your pencils. First is that the aim of risk analysis is to lead to a risk strategy and the effective execution of it. Okay? First of all, I would say that most companies don't have a risk strategy, a strategy to protect them from bad things. Most companies focus on the upside. We focus, and you can imagine how depressing it is for me every day, focus on the bad things that happen. It's actually fascinating, but nonetheless. Second, a key to a strong risk management is understanding your company's tolerance for risk. Critical. What is it that you can stand? What is a crisis to you as a company? If you know it, and it's going to be different from company to company, but you can't design an effective protection program unless you know what your tolerance is. So don't worry about the things that you've got plenty of tolerance for that don't really matter, just the ones that matter. All risk can and should be described in a single language of frequency and severity. There are many languages of risk out there, at least 4 or 5 typically in the kinds of companies that we deal with. We try to bring that together in a single language so that different kinds of departments, different geographies can talk to one another. That single risks rarely bring down a company, multiple risk scenarios do. That every prominent company can expect to suffer an extreme reversal of fortune about every 7 years. That it's critical to focus more attention on preparedness rather than on prediction. Don't try to spend so much time in predicting whether or not you're going to have an oil spill particularly, or or anything else, being kicked out of a country. Just know that there will be some combination of events that will happen, and you need to be ready to respond to those. It's critical to focus more attention on, okay, so risk is now the first item on the agenda of outstanding boards of directors. You may say, well, of course, hasn't it been on the, no, it has not been on the top of the agenda of most boards of directors. Most boards are still audiences rather than participants in major risk management. This needs to change. Most boards receive a risk report. It might be 10 minutes, twice a year, if maybe once a year, more likely. But in effect, they need to begin to own the risk. They need to direct top management. So that's all happening. Again, plenty ahead of for a lot of MBA students to participate in and to advance in companies that you go to. Risk strategy is the choices you make between risk finance and risk mitigation, and a risk strategy is only as good as its execution. That is all I'm going to take the risk in saying before we head into the weekend. But again, I want to thank you for staying and encouraging me to go on. I appreciate that. And I don't know if we have time for questions or anything, but thank you.
Thank you. So we have run out of time, but we can take time.
Thank you.
Antonio Rosso, MBA, LBS. I was wondering if you're also active in supporting the companies in dealing with the risks. So you're preparing the financial support, etc. But do you actually go in there? Do you have also the need for the technical knowledge, or is it just the financial one? Thank you very much.
Thank you for that question. It's a good one, and I would say that short answer is certain risks we are very much roll up our sleeves and help. And in particular in the natural catastrophe area, we have engineers that are specialized, a very specialized area, specialize in going on site and looking at, they've been at nuclear plants where the reserve generators aren't tied down. They're on rails so they can roll in fast, but they're not tied down, so that you get an earthquake and they roll away. That's kind of, sounds incredible, doesn't it? But I mean, those things happen. So we're heavily into that. We're heavily into fire and explosion kind of avoidance. But it is a frontier for us beyond that. We really need to become the risk preparedness kind of advisors that are really needed out there. It's a frontier for us.
Richard Hooks from Kiln. I'm an upstream underwriter.
Yep.
Okay. I wanted to actually just comment briefly regarding your comment that companies tend not to be so good at paying. The counterexample, the counterexample that's not often raised with Deepwater Horizon being the speed in which with which Transocean were reimbursed following the sinking. But really, my main question was with regards to your pointing out of how the liquidity crises are sort of brought on by sudden events. Is it, in your view, that the liquidity crisis drives the share price drop, or is it the event drives the share price drop, drives the liquidity crisis? And in which case, is that not the market responding to the fact that the company, as it turns out, is exposed to those sorts of extreme events?
So the chain, could you describe the chain again?
Well, I was clarifying that I had interpreted that you're saying, well, your position is that the event causes the share price to suddenly drop, which then drives the liquidity crisis for that company. Is that correct?
Yes, okay.
And so in light of that, is that not the equity markets really recognising what they hadn't recognised previously, i.e. that the company is exposed to those extreme events?
It is indeed. It is indeed. It's not a pejorative kind of statement to say that the banks are moving away, right, during that period, because the company is really at risk. The company may not be able to pay its bills. But usually it does end up being able to, it does survive, or ends up surviving. These are outstanding companies, that's the other thing. So there's almost the question that we ask ourselves is what's the moral hazard of providing capital to a company that's in a deep crisis like this, that may not, quote, deserve it? The fact is that every company goes through these crises. All the best management teams. It has almost nothing to do with management and good management. So, the markets do work in a sense. The point is that these groups are retaining the risk now. The clients, our clients, are retaining the risk on their balance sheets. It's not explicit to them often that that's what they're doing. So we're in several stages here. We're first of all making it explicit that they are retaining the risk, asking them the question whether there's a more efficient way of doing it, and then hopefully providing the solutions, including, I hope, solutions that'll be supported by the insurance market.
Thank you. If you have any more questions, you're free to ask during the networking drinks later on. Now, please join me in thanking Mr. Ellis for such a great presentation.
Thank you. Thank you.
Thank you.
Appreciate it. Thank you.